This daily dose is brought to you by Pirate.Black. ARRR!
As faith in the current financial system continues to fall, governments around the world are rushing to roll out their central bank digital currencies, or CBDCs, before their physical fiat currencies collapse. The European Central Bank, or ECB, has been leading the charge in this regard, and it recently published a working paper about its upcoming digital euro, which sheds light on what CBDCs will look like. Users will have no privacy and no control over their money in a CBDC system. The authors highlight the fact that over 90% of central banks around the world are working on a CBDC, and claim that the interest in CBDCs is due to the decline in cash payments, good joke, and the rise of unspecified digital currencies, which is presumably cryptocurrencies, and not a joke. I say presumably because the authors specify that these digital currencies, quote, pose significant challenges to the status quo of the current financial system, which is another understatement given that the implicit and explicit purpose of cryptocurrency is to replace the existing financial system. Naturally, the only solution to the alleged shortcomings of cryptocurrency is a permissioned, i.e. centrally controlled, distributed ledger that's operated by the government and the central bank. This ties into the third part of the paper, and that's the reasons why central banks want to roll out their dystopian digital currencies. The first reason is one that all central banks love to throw around, and that's that central bank money is the safest form of money. The authors then claim that, quote, as the use of cash is declining, the promise of convertibility at par becomes less and less meaningful. Call me crazy, but this sounds like a justification for the 1% reserve requirement that commercial banks have in the Eurozone. As you might have guessed, this basically means that European banks only need to keep 1% of all their customers' money in cash. A recipe for disaster as winter approaches, no doubt. The second reason why central banks want CBDCs is one that's been mentioned a couple of times already, and that's monetary sovereignty. A CBDC would make it possible for governments to prevent foreign currencies from competing with their national currencies. If you're wondering why governments and central banks don't like this currency competition, it's because it would fundamentally force them to act more responsibly with their spending and printing, which most governments and central banks don't want to do because it benefits them and their friends. As such, just about every country would quickly see its national currency replaced by some foreign currency, likely the US dollar in the form of stablecoins like USDT and USDC, given that this is slowly but surely starting to happen in countries that are experiencing the most inflation. The third reason why central banks want CBDCs is laughable, and that's for privacy protection. What's especially funny is that the authors pose the question, why do people want privacy in payments? Not surprisingly, the first answer they give is for illicit activity. The second answer to why people want privacy in payments is to protect themselves from corporations who want to use their data, or, as the authors call them, quote, monopolists. Believe it or not, but there was absolutely no mention about people wanting privacy in payments to, say, donate to a political party or support protesters, or buy things that governments don't like, such as firearms, cryptocurrency, and apparently also red meat. What's also not surprising is that the authors conclude that the private sector cannot provide any privacy guarantees, which logically means that the public sector is the only one that can, in this case the central bank and the government. What the authors don't say is something that's been said in many other CBDC papers, and that's that privacy would not be possible with a CBDC for this very reason. Now, the fourth reason why central banks want CBDCs is the real reason, in my opinion, and that's to, quote, address market imperfections. In other words, control the economy so that everything is perfect, according to the criteria of the people in power, that is. Obviously, the authors don't say this directly. Instead, they throw around words many in the crypto community are familiar with, such as faster payments and financial inclusion, which even the authors admit a little later on aren't issues in the Eurozone. The authors also mention that a CBDC could be used to address unspecified, quote, moral hazards in the economy, which almost certainly includes political donations, purchasing cryptocurrency, and all that other stuff I mentioned a few moments ago. Then the authors start to tread closer towards the real reason why central banks want CBDCs. Quote, "A CBDC introduction may allow governments to improve their control over payment infrastructures. Moreover, quote, a CBDC may provide a more efficient channel for governments to disperse fiscal transfers directly to citizens. And, quote, additional features such as programmability may enhance the efficiency of fiscal policy, for example, through transfers with an expiry date." Those last 2 points are particularly concerning because some CBDC papers have mentioned that requiring CBDCs to pay for taxes or receive emergency aid during a crisis are 2 ways that governments could force their citizens to adopt said CBDCs. As for the programmability, this relates to the explicit plans central banks have to set limits on how much you can buy, where you can buy it, when you can buy it, and even how much you can save using a CBDC. The 4th part of the paper pertains to how CBDCs would impact monetary policy, which some of you will know is everything the central bank does, namely raising and lowering interest rates and creating money out of thin air for the government, the commercial banks, and their buddies. The authors start by going over some research that suggests commercial banks could get squeezed by a CBDC. This is partially because there wouldn't really be a need for them, and partially because most people would opt to keep their CBDC holdings directly at the central bank for safety reasons. The authors seem to suggest that a solution would be to just have commercial banks compete by raising interest rates offered on CBDC deposits. The question is where these interest rates would come from, and the answer isn't all that obvious. Perhaps pure programmability by the central bank, i.e. printing. Now, another element the authors examine is the effect CBDCs would have on bank capital, which is quite honestly above my pay grade. For what it's worth, the authors note that, quote, the effect of CBDC on banks' profit retention decisions is ambiguous, which suggests that their analysis wasn't conclusive. Next, the authors assess the actual use of CBDCs to modify monetary policy, which the authors claim is, quote, not the main focus of central banks looking to roll out CBDCs. That's because most central banks want CBDCs to act like digital cash. As we've established, however, the ECB does want to use its digital euro to modify monetary policy and also wants it to replace physical cash. As far as I can tell, this is the case with most other central banks as well. Actions speak louder than words, after all. Now, the authors make this clear in the next paragraph, where they note that the ECB would love to use a CBDC to create negative interest rates. And I'll note that this is not the same as the negative interest rates the ECB had until very recently. Whereas negative interest rates with regular currency effectively pay you to borrow, negative interest rates with a CBDC means any currency you don't spend would be slowly but surely destroyed, thereby giving the central bank an uncanny amount of control over the economy. All the fiat inflation we're seeing could be intentional. The authors also admit that, quote, a CBDC carrying a negative interest rate might face adoption obstacles as users would perceive cash as a less costly means of payment. After discussing the possibility of creating different interest rates for different amounts of CBDC holdings, the authors even admit that, quote, such a scheme, however, would be difficult to explain to the public and might impede adoption as well as usability of CBDC for the average consumer, in particular in the presence of alternative private digital means of payment. And this, ladies and gents, is exactly why every country that's rolling out a CBDC is cracking down on cryptocurrency. In addition to killing cash, they must make sure there is no other kind of currency. Otherwise, their CBDCs will not work, and forcing them will accelerate the adoption of alternatives. The authors then touch on something absolutely terrifying, and that's a study which, quote, shows that the central bank can separately target the store of value and the means of exchange function of money by steering the supply of CBDC. Does this mean they're going to go after precious metals too? You tell me. Now, the next paragraph contains an even more disturbing sentence, and that's, quote, amongst the key choices, central banks will need to decide who should be able to use CBDC, whether and how it would be remunerated, and whether its use would be subject to holding or transaction limits. Besides the prospect of putting limits on CBDC holdings and transactions, what makes this sentence so disturbing is that the authors cite Raphael Auer, a member of the Bank for International Settlements, who has written extensively about how central banks should take total control of the financial system. A CBDC could force a central bank to start buying stocks and other assets and give them to commercial banks so they stay solvent in the event of excessive withdrawals due to CBDC demand. Mind-blowing, but not surprising. Wall Street needs to get its cut from this Ponzi scheme after all. Now, the central bankers seem to be fine with this setup, as a study the authors cite says, quote, "To the extent that a CBDC increases the usefulness of central bank money and draws demand away from private monetary assets, it has the potential to increase the central bank's control over monetary policy and its ability to reap seigniorage. Anything in the name of control." The silver lining is that the central bank's ability to control the economy through a CBDC would be dependent on its adoption, which could again be negatively impacted by the presence of competing CBDCs, cash, and cryptocurrencies. Anywho, the fifth part of the paper talks about the implications a CBDC would have on financial stability, something that's already been touched on to a limited extent. The authors begin by throwing shade at commercial banks, with sentences such as, quote, "Banks raise funds in the form of demandable deposits and invest them in illiquid and risky assets." To be fair, the authors mention this in the context of bank runs, which can occur when everyone tries to cash out and the bank is forced to liquidate the assets on its balance sheet. Depending on the assets in question, the liquidation may not be enough to cover the cash that people want to withdraw. As I mentioned earlier, there is a concern that a CBDC would increase the risk of bank runs, as during a time of crisis, everyone would rush to convert their cash into a CBDC, or so the central bankers say. After going over a few simulations of all the different conditions in which a bank run would occur because of a CBDC, the authors turn to another financial stability issue caused by CBDCs, and that's that banks might start loading their balance sheets with more volatile sources of funding to stay afloat in the absence of sufficient consumer deposits. Rather than scrap the CBDC and avoid all the issues discussed so far, the authors propose that central banks put limits on how much CBDC an individual or institution could hold, and reveal that the ECB is actively examining the possibility of such setups. The authors continue building on the idea that the introduction of a CBDC would inspire commercial banks to increase risk-taking to maintain their profitability. While a CBDC would make it easier to implement financial stability policy due to the rich data that regulators would be able to gather, this data might not be of high quality if, say, limits on CBDC holdings and transfers are imposed. The devil's dilemma, if you will. Now, the sixth part of the paper concerns the policy around and adoption of CBDCs, including how central banks intend on convincing you and me to use their dystopian digital currencies. The authors commence by commending the Bahamas and Nigeria for being the first two countries to roll out their respective central bank digital currencies, while acknowledging that a CBDC might not be appropriate for every country or region. The authors then make a bold claim, and that's, quote, "There is no regulatory alternative that promises to eliminate the threat to the two-layer monetary system. Since cash is only available in physical form, it is by construction not fit for the digital age."
Cash is not fit for the digital age.
That's some radical rhetoric right there. And then the authors say the quiet part out loud. Quote, "The introduction of digital cash in the form of a CBDC appears to be the only solution to guarantee a smooth continuation of the current monetary system, an admission so significant that it made the crypto headlines. And because cryptocurrency provides an alternative to the current monetary system the central banks are trying to preserve, the authors advise that, quote, "Public policy must act decisively and in a forward-looking manner," meaning they must crack down before crypto adoption takes off. Even if cryptocurrency is not a competitor, it is a viable alternative that the average person could flee to in the event that CBDCs go full dystopian. And this is an option that almost every government doesn't want its citizens to have. At the same time, however, a CBDC rollout is bullish for cryptocurrencies precisely because they are the alternative. and there's only so much governments can do to stop them because all you need to access them is an internet connection. Not all cryptocurrencies are created equal, however. Some, namely smaller cryptocurrencies that use a proof-of-stake consensus mechanism, could quickly succumb to government and central bank pressure that's being exercised by their friends in finance, be it BlackRock or otherwise. This risk is especially relevant to centralized stablecoins like Circle's USDC, which some of you will know is being supported by BlackRock itself. That's why other cryptocurrencies, namely Bitcoin's BTC, could stand to gain on a CBDC rollout, especially if governments start going after other stores of value that are easier to confiscate, such as gold. The only issue with BTC is its transparency, which could be solved with privacy solutions in the future at the Layer 1 or Layer 2 level. In the interim, CBDC rollouts could end up being bullish for privacy coins. Now, it's important to note that all of this assumes that central banks will succeed in rolling out their CBDCs, and that's certainly not guaranteed. In fact, I find it even more likely that they will fail, especially since nobody except select politicians and central bankers are fans of their problematic properties, be it transaction limits or otherwise. Nobody will voluntarily adopt this technology, and that means governments and central banks will have to find some way of making CBDCs the only option. A combination of hyperinflation and successive crises could be the secret, but they'd never stoop that low to get their way, would they?
Follow the treasure to pirate.black, because financial privacy today is freedom tomorrow. ARRR!